Hi everyone, here we go again, this time analyzing Facebook. In this first slide, we can see some key points that we'll see later in detail. One of the most impressive figures is 3.3 out of 7.8 billion world population are Facebook companies users. WhatsApp has more than 2 billion daily users. Instagram is the shopping center. Facebook Blue is the advertising company. Oculus is about virtual reality, and one of the big bets, Novi, which is a connected wallet, works under blockchain technology. And in the bottom, you can see the margins that are clearly the ones of a high quality company. And the fact that they are sustained over time means that they also are huge competitive advantages indicators. The current price is $315, and we are going to see why I think it should be more than $500. Well, this is the usual disclaimer that is in every single presentation. This video is not any kind of recommendation. You must not buy or sell any financial products related to Facebook based on this video. You have to make your own analysis and make your own decisions, just in case you are going to buy or sell, of course. This video is only for formative or informative purposes. I do have to let you know that I currently own Facebook shares, but I don't work for the company and they don't pay me for making this video. If you like this kind of video, subscribe, like, and share it. Well, like the first video, the agenda will be similar, at least for now. A general overview, business, market, and competitors, management team, the financial data over time, and an outlook based on what the company and the analysts say, and my own thoughts as well. The main risk, where we try to guess whether the outlook is feasible, at the same time that we check the risk that shareholders are taking. Finally, the company valuation based on the previous information in several scenarios. So we'll get a range of values instead of a number. This is the Canvas model applied to Facebook, extracted from the Business Strategy Hub. It's a very good big picture of the entire business. The only thing I don't agree is where the users are. In my opinion, most of the users are not customers, so they might be in value propositions. Right here, since they are the product or part of the product in the customer segment that I will let the advertiser and marketers, so which are the business that are paying for the products. So I would leave it here. And YouTubers, if we were talking about YouTube, maybe key partners, because they were content creator, but they are receiving money or they are earning money, right? Although it is considered a tech company and usually is compared and integrated into the fan group, Facebook is an advertising company. Actually, almost 99% of the revenues come from the advertising business. The product are the users, and the clients are the businesses that are paying for advertising. And there is a huge room to grow because only 10 million out of 200 million businesses users are clients, paying for services. In the digital advertising, there is a duopoly where between Google and Facebook have 90% of the market share. The revenues growth continues and is expected to continue higher than 20%, in spite of decreasing from 50% over the last years. The management has half skin in the game because only Zuckerberg has more than $100 billion in shares, which means all the business decisions they make or policies they establish impact directly on his wealth. Another way to see the good management is the capital allocation, where they have been doing pretty well in terms of acquisitions, investment, stock buybacks, etc. The stock price has been growing at 29% compounded annual rate since the IPO. The main challenge and risk are the legal issues, not only the fines, but the privacy, data protection, which also produce reputational damage. Another legal threat is the monopolistic regulation, where the company could be driven by to make spin-offs. I do not consider this is a risk because in that case, our value as shareholders will be increased because Facebook worth much more by separating the businesses. And finally, the attractive valuation based on the previous information. Well, before going to the current business, let's briefly review the company's history. It was founded in 2004, as you may know, by Mark Zuckerberg, Eduardo Saverin, Dustin Moskovitz, and Chris Hughes. You can see this part in the film The Social Network that I highly recommend watching. Actually, Mark Zuckerberg stole the idea from the Winklevoss twins, who were also Harvard students at the time. Then created the brand the Facebook with the article "The" that was removed after Sean Parker, the Nasdaq founder, recommended. Initially, it was created for flirting, basically. It was Harvard Social Network, but quickly it was expanded to the rest of American universities and abroad. The unexpected growth was extremely fast. In less than 1 year, they reached 1 million users. During several years, they developed the platform. In the film, you can watch how they moved to Silicon Valley when Mark met Sean Parker, the problems with Eduardo Saverin, and so on. In 2011, Messenger was introduced. In 2012, they bought Instagram. This purchase was highly criticized because of the price, 19 billion. But looking back, it seemed very cheap, since the value today can be 15 times higher, only 8 years later. This made clear that the management got talent in terms of acquisitions. This year went public as well, and only 1 year later, Instagram reached 100 million monthly users. In 2016, released the Workplace. In 2017, started the e-commerce with the Instagram Shopping. This year reached 2 billion monthly users in Facebook Blue. Also in 1917, 1 billion people use WhatsApp daily, and currently 2 billion. This was another criticized purchase because they pay 1 billion for the company, and today we couldn't say the value. But if we charge $1 per month per user, I'm pretty sure we all keep on using it, and that means $24 billion extra in revenues. The potential monetization, and taking into account that the current revenues are 85% billion, we are talking about a huge percentage of the current revenues. The potential monetization is huge without any cost because this is already working. Instagram in 2018 reached 1 billion monthly users. And finally, Novi, the connected wallet that uses blockchain technology, was released in 2019. This is probably the Facebook gate to fintech world, and we will see what happened, but looks pretty good. Well, after this quick review of the history, we are going to talk about the main platforms. Facebook Blue, it's like they call it, Facebook Blue, when we are talking about only Facebook, not the other apps, right? With 2.7 billion monthly users, which means 35% of the world population. This sounds incredible. Messenger with 1.3 billion, Instagram 1.2 billion, and WhatsApp with 2 billion, in this case, daily users. So about a quarter of the world population use it daily, which is really, really impressive. The latest businesses are the augmented and virtual reality. They have 12,000 employees. In other words, about 20% of the total Facebook employees working exclusively in Oculus. As an example of the application of virtual reality, can be visiting when you are going to book a hotel. You can visit it before booking it, and not only watching the pictures or or the 3D visit, that is not exactly the same. You can visit a house before buying or renting. These examples are quite different than the 16 3D visits in the real estate websites. And this will be a real image and time where you can make a better and realistic idea. They connect the wallet for digital payments based on blockchain technology. And this is, I think, this have a lot of future since the traditional biggest banks in the world are investing in blockchain technology as well. Facebook ranking audience by countries. Let us see the following figures. India is leading the ranking with 320 million users, but there is room to grow since the average percentage of user by country is over 50% of their population. At this point, only India could increase hundreds of million users in the near future. As we can see in Mexico or South Asia, the percentage goes up over 70%. In summary, there are impressive figures and still room to grow in many countries. But in my personal opinion, the future growth in revenues has to come because of pricing, not keep on growing in users. It's more about the loyalty of or the engagement of the users. The company measures its activity based on operational metrics, which are the monthly and daily active users and people or family, how they call it. The user means Facebook users, and people or family means users at least in one of the companies. All are in upward trends, but we can see how the people users are growing at faster pace. We can also see that around 3.3 billion people, 40% of the world population, are using Facebook company monthly. There is a popular saying, when something is free, then the product is you. The real product is the user attention. How to capture? Basically improving the user experience and investing to keep the engagement. The business, as I said before, is an advertising company, not a tech company, even though it uses cutting-edge technology, of course. But the revenues come from selling advertising. So when some famous investors or analysts call it a tech company that belongs to a tech bubble because it's a young company and a new business, I completely disagree with them because it's an advertising company and this business is one of the oldest in history. Facebook has a great advantage because of focus on advertising. As John Wanamaker said, he wasted half of the money spent in advertising, but his problem was he didn't know which half. And this problem is fixed with Facebook, with the segmentation that Facebook is able to make, increasing the return on investment. The network effect is the Facebook Great Moat, as the Chinese Great Wall was a defensive huge tool for them. Here for Facebook is the Great Moat is the network effect, which should be included as a textbook example of competitive advantage. Sorry, this one. The important thing about the network is that has been built over many years. Then it is not an easy job to build a new one able to compete. Adding the brand, which is worldwide very well known. Zuckerberg is a competitive advantage himself because of his long-term vision and management. The pricing power, in fact, has been the driver for 46% increased revenue in the last first quarter. The duopoly is a classic mode, as we already seen. Google and Facebook have it. On top of focus on targeted advertising, it must be added that Facebook has a greater segmentation possible than anyone. They are investing a huge amount of money in research and development every single year to increase the engagement that few companies could do the same. The user are not only the product, they also are cost saving because they are the content creators. This is an important difference with the traditional advertising. They need to create or buy programs or contents to attract people and advertise their attention. And that, for instance, they have to create a really good program. For example, or for instance, on TV, in in prime time to make the business attraction to buy advertising for in that time. And here all that kind of programs or content cost a lot of money, and here is for free because the user are the content creators, so they are saving a lot of money here. And this is one of the reasons why Facebook has the highest margins. For instance, even Google has a gross margin of 40%, meanwhile Facebook has 80%. This let us know that also Google has to spend money to get clients because there is no content. Well, as we saw 2.6 billion user or audience daily, there is nothing to add here. It talks by itself. The network effect makes that one user create value. And this is different than the traditional one as well, because the net effect makes that one user creates another net, so it's exponentially growing. Let's have a look at the market. The market has room to grow. Currently, the advertising market is over 600 billion, 50% digital, and is expected to be more than 800 billion by 2025 and increasing to 65% the digital part. Making a quick extrapolation, keeping the same market share by company, Facebook will go from the current 85 billion in revenues to $200 billion in revenue. Advertising in general is growing at the GDP pace, but online 13% and mobile at 21%. As we've seen in the advantages, this market is a duopoly. The competitors by segment or division, instant messaging, the Russian Telegram and the Chinese WeChat. In social networks, they compete against TikTok, Snapchat, Pinterest, and Twitter. There is a big difference with Twitter because it's more traditional media. They cannot make such a big segmentation. And as advertising business, Google, the main competitor, YouTube, but also with Amazon that is growing every year, Apple, Tencent, and Microsoft. This is the social network ranking by monthly users as of January 2021. It is impressive to see that 4 out of top 5 are Facebook companies. Only YouTube is able to get similar number. About suppliers, there are customers that are attracted by themselves and also have a self-service platform that makes a scale economy. They can create, manage their own ads. But the company spends money in attracting customers as well. Global sales force with more than 80 offices worldwide. Collaborators such as agencies and resellers, but there is also self-service platform for these ones. Again, we have a scale economy in supporting customers. Here we're going to start to make a quantitative comparison with metrics and valuation multiples. All these slides represent 2 time periods, 3 and 10 years respectively. It is possible that some companies do not appear in 10-year periods because there is no data or they didn't go public at the moment. The orange lines are Facebook's, so we will pay attention how are their behaviors. Let's start with the gross margins. It's an impressive 80%, stable over time and clearly higher than peers. The EBITDA about 50% on average, and again above the competitors. The EBIT about 40% and the same thing. The net income about 35% and above competitors' average. Here, the free cash flow, we can see that this is stable over time. The last 3 years above 20%, but it used to be above 30%. This is punctual downward due to the increase in capex and investment for the long term, for the short term, sorry, and on cybersecurity, the compliance department, and so on. But it's expected to be back to the mean soon. Also, there was a fall in 2012, but this was the Instagram purchase. The return on equity about 30% on upward trend last decade. The return on asset about 25% on same trend. The return on capital likewise and above 20% and above all these peers. And about the valuation multiples, the price-earnings ratio is lower than competitors. Taking into account the company quality and being cheaper than peers, it makes me think about something can be missing. On the other hand, it's trading at 27 times net income. Meanwhile, the market is at 20. It doesn't look like a bargain as well. But we will see later what happened with this. Sorry. Bounce. Yeah, I wanted to say something more about the PE ratio. Sorry. This one, the PE ratio. I wanted to say another thing is we're going to do something is to keep in mind a number, which is we can see in both plots the minimum PE ratio, which should be about 20, maybe for a few days 18, but on the long time is clearly over 20. So let's fix and remember the PE 20 as minimum. Okay. The enterprise to EBITDA ratio about 18 on the industry average and downward trend. Price to sales ratio under the threshold of 10, which is my limit as investor, but it was even at 20 times sales years ago. This downward trend will continue. Actually, this comparison is not really fair, since Google sales are higher, but not at all come from advertising. About the management, the first thing is highlighted the CEO. Mark Zuckerberg, he's running the company for 16 years since foundation. Has a lot of experience, but he's only 36 years old, so there is room to keep on doing the good work he does. He's absolutely committed with the company because he owns more than $100 billion in shares. He's been very clever, keeping 60% of the vote rights in spite of his ownership, which is 13% of the market cap, which is really important to be free in terms of running the company. He showed that he's an excellent manager with facts, expert on purchasing companies, as we saw before, treat well the shareholder, buying back shares although don't pay dividends, and I prefer it. I prefer it because he reinvests the money at a higher return on capital. An individual investor, we save money not paying taxes for dividend income. Keep the company debt-free and creates value being focused on higher return margins. The fact that the public opinion is negative about him and the market is penalizing the stock, I think he's an undervalued CEO. In terms of compensation, he's earning $26 billion. His compensation is much lower than companies of less market cap and less quality. The base salary is a symbolic one single dollar, and the rest are his expenses to live and security as well. I usually fix a threshold of 1% of revenues, and his compensation is about 0.03%, so it's quite low. The board of directors have in common that they study at prestigious universities and on average 10 years working for the company. I want to point out Jennifer Newsted, who was a civil servant working for the government as well in the White House, expert in legislative issues, and she came 2 years ago to work on fixing the legal issues. Here we got the head of WhatsApp, the head of Instagram, and so on. They already are 60,000 employees and still growing, more than 80 offices worldwide, a strong corporate culture where the core are diversity and inclusion, competitive compensation to attract and retain talent, and annual equity compensation to make the employees feel owners and committed with the long-term strategy. The insiders own 15% of the company, where 13% are Zuckerberg's ownership. Eduardo Saverin has 1%, and as you can watch on the film, he's not on the board and has a smaller ownership because he's conflict with Zuckerberg and Sean Parker. An important figure right here is that institutions such as investment funds has 67%, which is a smaller proportion than usual in a blue chip. Well, let's talk about the financial data. Exponential growth in revenues, also an upward trend in EBITDA, EBIT, and net income, but not so much due to what we've been talking about, the unusual expenses and investment in the short term. Anyway, the earnings per share have been growing from 30 cents in 2011 to $10 in 2020. The shares have been diluted a bit until, as you can see here, until 2017, more or less. But if we look at the revenues and the balance sheet evolution, it is irrelevant. Even more after 2017 started to repurchase stocks, as we can see here. And also we can see how the company has created value. When we look at the book value per share, we can see that came from almost $5 to $41 currently, which is 8 times more in only 8 years. In terms of revenue per continent, we can compare the in this slide is I was thinking about this one, but we are here. Yeah. In this slide, we can observe the seasonality in revenues, where the fourth quarter normally is where the company makes more money than the rest. But we can also see that in 2021, the first quarter has fallen less in relative terms than the 2020 first quarter. In terms of revenue per continent, as we saw, we can compare the 4 quarters, for instance, where we can check that the average revenue per user in North America is 5 times the worldwide average. So the rest of the world has potential to increase the total revenues in the coming years. Profit margins are the highest in the industry, and the usual ones when a company have a strong competitive advantage, and we saw these metrics when we make the comparison in the market. Facebook has a solid rocket balance sheet. I wanted to show you with color bars instead of numbers like the last time to make clear image. The dark blue is the cash and equivalents, which normally is between 60 and 40%, which is 40% of the total assets. Intangibles are in a downward trend after the Instagram purchase in 2012. Properties and intangible assets are such as infrastructure are increasing since then too. About the liabilities, 80-90% are equity and is debt-free or insignificant. The return on assets, equity, and total capital, again, the highest in the industry, and indicators of competitive advantages. Well, let's see the outlook for the coming years based on what the company says, what the analysts publish, and my own opinion. It's a mix between all of them. The market expects Facebook to grow about 20% annually the next 5 years. The potential customers are 190 million businesses, because 10 out of 200 million businesses users are clients as well. So there's a lot of room to grow there. The global digital transformation is also an opportunity for Facebook as well, of course. In the 2021 first quarter, the revenues has been increased by 46% due to the increase in prices. That's a proof of the pricing power we've seen before. Instagram is helping a lot to customers to get into the e-commerce. The expenses in research and development will keep going strong and focus on the e-commerce and virtual reality. The current second-hand market, the current second-hand market in the US is 28 billion, and is expected to be 80 billion by 2030. And Facebook want to take its part of in this pie. WhatsApp payments already live in India and coming soon in Brazil. Another very important investment in infrastructure to be independent of third parties in terms of not need to outsource cloud, internet access, data centers, and so on. The analysts forecast are 206 billion in revenues. That was why I told you about, remember, the 200 billion, when we have extrapolated the market size expected for advertising in 2025. So I guess they did the same to compute it. For my forecasting, I will be more conservative. I'll take 160 billion, 20% less than the market, even though the company normally beats positively the market. Well, about the earnings per share is $23. So let's remember those figures, as the $23 EPS and 20 P ratio, and let's use it later. Okay, let's check the risk. Sorry, because my mouse, it doesn't work really well today. I don't know why. Wait a second. Okay. Prioritization the long term can penalize the short term. Competitors can beat you, or even worse, the long term strategy failed and you are lost totally. A risk that is facing right now is the iOS update that Apple did it. That is estimated to impact by 7% on revenues, but it seems not so hard due to the growth forecasted about 20%. Sales concentration in advertising, but it is increasing in new businesses. Dealing with competitors as usual. Years before used to buy them, but now they don't even need it. Just by copying can beat them and make them disappear. The unfavorable media coverage is not going to disappear because Facebook is a direct competitor and is gaining market share. Regulation is one of the biggest risks, mainly because of privacy and cybersecurity, but they are spending lots of money to deal with it and also getting ready the company for the future compliance. Let's translate this story into numbers. The stock evolution has been a compounded annual growth of 29% since the IPO, which is impressive. The EPS stock price are correlated. In this plot, I wanted to show the high correlation between the EPS and the stock price. This makes clear that in spite of the volatility, the stock price is going to follow the EPS on the long run. So that's what I really pay attention when investing in stocks. I don't let myself be guided by market sentiment on intuition. I let myself be guided in several things. This one between them. The discounted free cash flow valuation is easy to compute with the formulas, but the hardest part is to be right with the hypothesis. That's why to know and understand the company story as much as possible is the key to make the more accurate hypothesis. The analysts are over 20% revenue growth, but I will use 19% for the next 5 years. Free cash flow margin 28%, discount rate 7%, but I will use 8%, a bit more conservative, and has a big impact in the valuation. And the perpetual growth of 5%, although the forecasts are higher than 15% after 2025, but usually this rate used to be 2%. So I think 2% is ridiculous. So using 5% is still very conservative, but more realistic than 2%. Given this choice, the estimated value by 2025 will be $535. The same using my own hypothesis, which means revenues growth 14%, free cash flow 23%, and the same discount and perpetual growth, ending up in an estimated value of $365. The current price is $315, so the downside is very limited, and the upside higher than 70%. Multiples valuation with analyst consensus using the market forecasting about EBITDA, EBIT, net income, free cash flow, and book value, and considering 3 scenarios when the multiples are the historical lowest, another with the averages, an optimistic one with the highest. As an example, we can see how compute the peer valuation when using the lowest. As you can remember, I said down here in the bottom right, you can see here that as you can remember, I said the lowest P was 20, and the EPS forecast was 23 by 2025. So the estimated value is $460. So the same thing for each multiple in each scenario, but we have to use the common sense as well, because the highest P is 80, the average is 36, and the lowest is 20. So I will take much better 30 as the highest, 25 as the average, and 20 as the lowest, which is more conservative. In this situation, then compute the average in each scenario, and we got the following valuation. We got the following valuation: $551 in the minimum case, in the lowest case, 730 for the average, and $911 for the optimistic valuation. Here on the right side, you can also see the good returns we can get with this investment even in the worst scenario, which is 80% internal return rate and 80% the total return. Okay, let's likewise with my own hypothesis that are more conservative about EBITDA, EBIT, net income, and so on. Using the historical multiples as well, we get to $343, $455, and $569 in the highest scenario. Using the average scenarios analyst, which was 730 and mine 455, let's say the value can be more than 500 and less than 600, the most probable scenario. Finally, to have a look at the momentum to buy or sell, I don't use the technical analysis. I'm not a trader, but I build machine learning models to predict the momentum based on technical and fundamental data. I took the last 10 years of daily technical data plus the trimestral fundamental information published. I left 20% of the sample apart for a test out of sample. For those who don't know about model methodology, This is just to leave a part of the real data out of the model construction. This way, that information is unknown for the model, and we will be able to check how the model predicts the unknown data. The target is to guess if the stock price will be higher than 10% 1 year later or not. I make a selection of 15 out of 130 features when running different models such as neural network, random forest, XGBoost, and based on the accuracy and the feature selected, I choose the best one. In this case, an extra tree model was the choice. Using the test out of sample, we see how good the model performance is. In this case, it's an impressive precision of 97%. In other words, 142 out of 147 that the model said is going to be higher than 10% were right. As we can see on the bottom left, we have 5 random cases where the model say yes in all cases in different dates: November, December, January, February, March, and it was more than 10%. In the lowest case was 30%, and the rest were higher. And what I let here for the next year update is a prediction for the last 5 days of April, and the model tell us that they're gonna be higher than 10%. So we will see what happened then. Well, the presentation ends here, and it has been long enough. But for you that are still alive, and I'm going to give you a bonus because you really deserve it. And the first question we must ask ourselves, and we didn't, is why do we think it's trading undervalued? Because we have been in a row ending up in a decision which is undervalued, and the figures and we thought that is valued between 500 and 600, but we didn't ask why. Well, in my point of view, I can be wrong, but I think this is what I think. The market penalized the growth rate downward trend from 50% to 25%. But this is still considered, I personally still consider that 25% is a huge rate of growth. And the forecasts are higher than 20%. The regulatory pressure, there are 2 types: data protection, that's really important risks, but the other ones are the issues related to monopolistic legislation, that press is always talking, have bad press in this way. But in the worst case possible, the government can force Facebook to divide the business through a spin-off, and that's not negative at all. That makes more even worth the company, because that makes more hidden value come up. And the bad press is something that is going to continue as they are competitors. And last but not least, the real bonus, which is a free lunch. The estimations don't take into account these hidden values, right? WhatsApp online sales are starting and are estimated by analysts will be higher than 10 billion. I will take 5 billion to be conservative. Virtual store estimated additional 20 billion. I'll take 10 billion. And virtual reality about 10 billion. And I'll take 5 billion. So the estimation in these businesses in general, and extrapolating with the competitors, are these figures. I divide it by 2. So we have an extra EBIT of 20 billion. And now currently is 33 billion. So we are adding a 60% in EBIT. So you can imagine if we say that the company our valuation was 550, for instance, we are talking about a new valuation if these hidden values come up, about 900 more or less. Well, now this is the true end. I hope you like it. See you next time. and good investment.